Have you ever thought what differentiates legendary investors like Warren Buffett, Peter Lynch, Radhakishan Damani, and Rakesh Jhunjhunwala from run-of-the-mill investors? While all of them have different investing styles, they are So a couple of weeks back, I was talking to the CIO of a very large asset management company, and I asked him what differentiates legendary investors like Howard Marks, Benjamin Graham, and our fund managers. He said fund managers and research analysts know everything about the company that they're investing in. They know what kind of profit the company will make, where the money will come from, and what kind of growth that particular company will see. In spite of knowing all the technical things about that particular company, they miss the forest for the tree. Confused? Let me explain the entire thing in this video. Just look around in your investment world. You will see research analysts, fund managers, and investors who are your friends who can solve or analyze a lot of problems at breakneck speed, but the moment you give them a problem that they have never faced before, they are stuck and not able to solve it. You know why? Because they are trained in finance to analyze financial statements or give out valuation ratios. Just ask them what is the debt coverage ratio, next 5 years EPS projection of a certain company, and these guys will give you great answers. But that doesn't make them great investors, isn't it? Just try and interview a fund manager for a TV show or for a book. You will see that they are always ready to share their wisdom about growth prospect of a country or for a company. They are always ready to debate growth versus value stock or what RBI will or should do in the next quarterly meeting. They always are talking books. This doesn't make them a great investor. And now think of the greatest investors. Investors like Warren Buffett, Peter Lynch, Seth Klarman, and my favorite Howard Marks, and our own Rakesh Jhunjhunwala and Radhakishan Damani. We all agree that they have different investing approaches and different style of investing, but they have one thing in common. They are all investment philosophers.
See, the human mind has an inertia. It wants to be part of the crowd thinking. But we have to have deeper thoughts.
If you listen to them carefully, you will figure out that they never talk about technical stuff. Instead, they focus on the big themes and trends that are running in the markets today and will continue to run well into the future. They always base their analysis on fundamental drivers of the particular trend and never the recent data flow. They have ways to understand the underlying market dynamics. In other ways, they always try to assess investments in fundamental and informative way and not just basis data. All these lead to one simple thing which Carl Jacobi mentioned long time ago. Inward, always inward. Jacobi used to argue saying that if you need to find a solution for a big problem, try to invert the problem, you know the solution, and now try to work backwards. This will give easier solution for a very complex problem. Isn't it common sense? In the spirit of invert, always invert. If you want to become a great investor, all you have to do is become investment philosopher. You should focus on understanding the market dynamics more than just understanding fundamentals and also the DuPont analysis of return on equity. Of course, those skills are important, but it is important to understand the fundamental factors. The data will always keep you busy, but that will never make you a great investor. Now that you've understood what can make you a great investor, let's try and become investment philosopher. Good luck.
मैं बोल रहा हूँ हमारा टाइम आएगा नहीं, हमारा टाइम आ गया है. हमारा टाइम आएगा से हमारा टाइम आ गया है अलग है. अब आ गया है. People will be surprised at the upsides in the Indian economy.